What is M0, M1, M2, M3 and M4? This topic of money aggregates has been time and again asked in UPSC previous year questions. Like if you can see the theme, it is repeated every year. So the next 25 minutes will give you the clarity on this topic and what economic survey this year says about issues regarding this. So this is a comprehensive video on the current affairs related to this aspect. Based on the previous year questions, money supply and the basics related to that is an important theme. So this is the chapter 4 of economic survey, and within that we have monetary developments. So we'll be looking at the trends, that is the latest updates from economic survey, and the basics here. The other aspects will be dealt in the subsequent videos. In the previous chapter, when we were talking about the topic of inflation, we have seen how supply and demand should be in equilibrium. One major factor concerning the supply and demand which decides inflation is money supply, and for this practical reason it is important for the government to track how much money is there in the economy, and the mandate is given to RBI. Also, you have to understand that government cannot dictate RBI to print as much money as it wants. So this scenario is not possible. Let us understand why. As you can see from this particular Live Mint article, there is a direct relation between money supply and inflation in India. If there is more supply of money in the economy, inflation rises, and if there is less supply, it will reduce. But this is an oversimplification. Let us try to understand the nuances relevant from the previous year questions perspective. Remember that when we are talking about Indian economy, we are only concerned with Indian rupee. So if you are having a confusion that even in our economy dollar influx will be there, so all those will be converted into Indian rupees, and for the sake of convenience we are just focused on Indian rupee only. So do not get confused and think about any other currency. Now it is very clear that RBI needs certain metrics to decide what is the amount of cash that is available in an economy. So those metrics are called money aggregates, and they depend on something called liquidity. Now what is liquidity? For example, if you go to a tea shop and take a cup of tea which costs around 5 rupees, if you have cash in your hand, it is the easiest form of transaction. Let's say you don't have cash and you decide to write a check of 5 rupees to that tea seller. Do you think the person would be more willing to take a check or a 5 rupee coin? It is obviously a 5 rupee coin because it is immediately transactable. So another example would be a land. If a person has a land, there is a scope that in the future it might be increasing in its value, but the problem is it is not readily transactable. So the ease with which you can carry out a transaction decides the liquidity of an asset in an economy. So just understand this. Now what metrics are considered by RBI for looking at money aggregates? Firstly, it is the currency in hand. That is, people hold certain amount of money with themselves in their pockets, in their wallets, and that is considered to be the hard cash which is held by the public. Secondly, people also hold their cash in savings accounts, fixed deposits in banks. Before this fintech revolution, normally in rural areas, people also held cash in their savings deposits of post offices and then fixed deposits of post offices. So you already know that post office is much less liquid because the pain that one should go through to withdraw their money from a post office is much higher when you compare to a private bank which gives you the facility of net banking. So this is the concept of liquidity. So here is where most of the MCQ questions are coming from. The first metric is M0 or reserve money. It is also called government money or high powered money. Take a look at this note. It says that there is a signature of the governor of RBI, and it says that I promise to pay the bearer the sum of 100 rupees. So why is this written on the currency note? You have to understand. What is the rationale behind this? The official currency of any government is called a fiat currency because the word fiat means there is a guarantee. Who is giving that guarantee? RBI governor on behalf of the government is giving this guarantee to us. So that is why rupee is called a fiat currency and gives us a sense of trust on this note that it can be used for our day-to-day transactions. Now, can RBI print as much money as it wants? No. Let us have a look at what RBI Act says in this regard. Basically, in a transaction, there are two sides. So if you take a look at accounts book of RBI, there will be assets and also liabilities. Liabilities means something that RBI in the future should give back, and assets means through which it can earn certain revenue. Now, if you take a look at the RBI Act 1935, only when the assets and liabilities match, the book of records will be safe. That is, there will be a balance of records. Now, these are the assets of RBI, and only when you have enough assets, the liabilities should be increased. Let's say in this case, if RBI wants to increase the cash held by public, it should print more money. This is possible only when the assets, any of these assets, increase. So every time government decides to print money or push more money into the public, it is done by printing more government securities. For MCQ purpose, remember that this clause that assets and liability should match is given in the RBI Act itself, and it makes logical sense also. This fractional reserve banking and credit creation is very important for our understanding. Now, this is an international website that I've taken this particular picture from. So, for all practical purposes, consider it to be Indian rupee rather than dollar. So, what is it that we are discussing here? Let's say, for example, RBI printed 1,000 rupees and gave it to a person called John. Now, this person got that money, and out of that, he's keeping 500 rupees with himself, and other 500 rupees, let's say he is depositing it in a bank like SBI. Obviously, the purpose of banks is to lend more money and generate interest out of that. So, they will lend this money to a person called Sue and retain certain interest. So in this way, the money supply grew from 1,000 to 1,500. How? Take a look at this. 500 is held by John in his hand, and the 500 that is there in the bank is again given to Sue. So this 500, this 500, and this 500 together will be 1,500. Now, what is the logic behind this? Actually, it is just 1,000 rupees, right? So this is where you have to understand how money is created in economy and why financial inclusion is extremely important. So what is the role of banking and financial institutions in our economy? It is mainly to create this money. A simple point that everyone should understand is every economy is like a cycle. Not all the people would need money at the same time. Now, it is very unlikely that every person would be willing to withdraw his fixed deposit at the same time. It would make a bank a failure, because it is very rare that kind of scenarios happen. Now, it might be possible because of extraordinary circumstances that a majority of the people would say that I want my deposits back. What should the bank do in such a case? Or what should the economy do in such a case? At least this M0, that is 1,000, which is printed by RBI, it should not get stuck. Let's say if Sue is actually in a construction business, she just constructed a house and left it midway because there is no money. So the cycle has actually stopped. This is the biggest problem of an economy, or a slowdown in an economy means that the activities are not progressing and thereby creating more money. So the logic that you have to understand is financial inclusion and banking system is very important for any economy. Based on this point, there was a question asked. Let us see. Before solving the question, let us understand this concept of velocity of money circulation. Now we have already discussed how money circulates in an economy through banking system. Now, if more and more number of people are supposed to take loans, there should be new economic activities, and government should actually play a positive role in creating this economic activities, right? Now, take a look at this particular graph. See the GDP growth from 1986. You would see that from the time of LPG reforms, the graph has increased substantially. Now, why is this possible? Because of the velocity of money circulation, that is, the speed with which money is changing hands from one person to another person. What this means is the cycle of economy is very nice, and it is actually booming. If this is the phase where actually our economy has boomed. Take this period from 2004 to 2007. The economy boomed with a lot of investments because the speed with which projects are getting executed without getting stuck was very high. That is why in this period more and more money was generated in our economy, and that is what we call as economic growth, GDP growth. Now, one more problem associated with Indian economy is income inequality. If you take a look at income inequality from 1961 to 2019, we can say that inequality is coming down, but still there is a significant inequality, which is the case with almost every developed country as well. So when we're talking about reforms, in simple words, we should make ease of doing business even more easier, and that benefits that we accrue from this business should actually be distributed equally. That is, we have to reduce income inequality. That is a simple logic here. Now let us take a look at this question given in 2019 as well as 2021. The money multiplier in an economy increases with which of the following? Let us discuss this concept of money multiplier more clearly. In the previous example, we have seen that high powered money, or the money printed by RBI, is 1000 rupees. So John held 500 rupees and kept 500 rupees in the bank. The bank has actually lent that 500 rupees to a person called Sue. Now, in a worst case scenario, let's imagine that this business failed and this 500 rupees is stuck, and this reduces the velocity of money. We have taken the example of this 50% constructed business of Sue. Nobody wants to occupy a 50% constructed house. Neither the construction workers would get money because they will not be able to gain employment from this person who does not have any more money. And in all practical cases, it is quite possible to say that it reduces the velocity of money circulation. So what should RBI do to avoid this scenario is the question here. So this money, high power money which is generated by RBI, should remain intact in an economy even in a worst case scenario. This is the thing. Now let us take a look at SBI's business. In the prior example, there are only two persons involved, John and Sue. Now let's say there are more depositors, X, Y, Z. They got their money from different scenarios, and they deposited 500 each. So 1, 2, 3, 4, 5. There is a total amount of 2500 which SBI can use to give loans. Now it is quite possible that this entire 2500 is given to one particular business and that business completely failed. So this entire money gets stuck, right? Like in the previous example. So in order to avoid this kind of a scenario, RBI has created something called reserve ratio. So this reserve ratio is something that RBI uses to protect this high powered money. So for all practical purposes, RBI can tell to SBI that, let's say, out of the 500 rupees that each person is giving in this case, you have to put 10% aside. And RBI tells this not just to SBI but all the banks that are there in an economy and all the financial institutions. It is compulsory to do that. Now, if you add this 10%, that is 50, 50, 50, not just in SBI but in all the banks, it so happens that finally it will account to this M0, which is 1000 rupees only. So this reserve ratio is actually protecting the high powered money, but also at the same time, because of the banking system and its activities, money is getting multiplied. So both the objectives are achieved here. So this is the money multiplier effect that we are talking about. So we talked about the fractional reserve banking and money multiplier effect and how credit is created in an economy. Credit means giving loans. Now let us take a look at the question that was asked in this prelims examination. The money multiplier effect in an economy increases with which one of the following? Obviously, if you increase the habit of banking amongst the people, only then you can have money multiplier. Without banking institutions, it is simply not possible to generate money. This is quite obvious. Increase in the cash reserve ratio actually reduces the amount of loans that banks can give. So increase in statutory liquidity ratio in the banks. Again, if you were increasing the ratio where money should retain some amount without lending, it will not create more money, obviously. So again, this is also not an option, and population of the country has got nothing to do with money multiplier, as we have seen in the example. So it is a direct, straightforward question. Increase in the banking habit of the people. This question was repeated 2 times. So in your mains topic, there is in GS3 paper a topic called inclusive growth. So one of the major components of inclusive growth is financial inclusion. You understand the reason now. Without banking system, it is not possible for formal credit access. And because of this reason, PM Jandan Yojana, which is about financial inclusion, has been a flagship scheme of this government. Financial inclusion does not stop with banking. It is also about strengthening our markets and increasing the confidence of middle class, especially on stock markets. And therefore, this generates more money in our economy, as we have already seen. Traditionally, a lot of households just hold their money in fixed deposits. Now they take a look at the fixed deposit loans. They're somewhere around 4 to 5%, whereas even the best mutual funds are giving a minimum return of 8 to 9%. Yet people are not risking their money to invest in mutual funds because of the lack of trust. It is this that the government must address and ensure that through regulatory bodies like SEBI, our financial markets are strengthened. Now, anyway, this is another topic altogether, but just since the context is here, I just wanted to briefly mention it in the topic of inclusive growth. Financial inclusion as a topic of inclusive growth. Moving on, we have seen that the purpose of this video was to understand the metrics by which RBI regulates our money supply. So those metrics are called money aggregates, and we have seen how M0 means high powered money, or the money which is created by RBI. We have already seen the concept of liquidity, or the ease with which a transaction can be carried out. So for the purpose of prelims examination, you have to understand there are certain metrics M1, M2, M3, M4. Just understand and remember these metrics. You just have to understand that it is linked to liquidity. As we move from M0 to M4, our liquidity, or the ease of carrying out a transaction, decreases. Let us see why. You have seen that M0 is nothing but the cash which is printed by RBI. So this is common component of M0, M1, M2, M3 and M4. Let us see what this M1, M2, M3 are. We'll get back to that in a second. Now, where would you find cash in an economy normally? In a traditional world, back then when there was no fintech revolution, people held money either in the form of direct cash or in their banks through savings account and fixed deposit, or in rural areas in post office, that is savings account or fixed deposit. Now this fixed deposit means that they are not easily liquid, like there is a lock-in period involved. Let's say if you put in a fixed deposit for 1 year, there will be a penalty if you withdraw that money beforehand. So in order to avoid that penalty, people do not withdraw that money. So it is not easy to take out that money. And when you compare the FDs of a post office and the bank, we can safely say that the money which is stuck in post office is much more difficult to get out than that of a bank right now, for various reasons. So therefore, liquidity in a post office is lower. You just have to understand this. Let us go back to that example of John. When John got money, he held 500 rupees in cash, and the rest of the 500 rupees he deposited in his savings account. So this case is called M1. Another case, let us imagine John decides that the remaining 500 rupees that he holds, he would put 200 rupees in his bank and send 300 rupees to his parents who are staying in a village, and that village does not have a bank and they want to use the post office savings account. So he puts that 300 rupees in the saving account of a post office. Now let us take another scenario. John decides that the 500 rupees of cash and the other 500 rupees, he will put 300 in the savings account of his bank and another 200 in the fixed deposit of his bank. So this is called M3. Now let us take another scenario wherein John decides that he would equally invest in all these accounts. Let's say he want to invest 100 rupees in his savings account, 200 rupees in his fixed deposit, and send 100 rupees to his parents in a village and deposit them for their daily expenses in a casa account, and the remaining 100 rupees in a fixed deposit of his parents. This is called M4. So any regulator will look at all these metrics and understand the cash flow in an economy where a particular amount of cash is held. And as per the textbook definition, this M3, which is a part of a classification called broad money, M3 and M4 are called broad money, and M1 and M2 are called narrow money. There is no need to go behind the logic or the reason for that nomenclature. It is not relevant for our examination. So M3 is actually the money supply that we are talking about in our economy. Who says this? RBI. M3 is used by RBI to decide what is the money supply in our economy. It is also called aggregate monetary resources. And simply put, it does not take the post office part into consideration if you take a look. So the simplest way to remember is whatever money that is there in a bank plus cash in hand together constitutes the money supply in an economy according to M3. Now let us try to solve a question that is asked in the prelims examination. Look at this question. It says that 1 lakh of cash is removed from demand deposit account at your bank. The immediate effect on aggregate money supply in the economy will be what? We know that aggregate money supply or M3 is nothing but cash in bank plus cash in hand. We just saw that explanation. Now if 1 lakh is removed from the fixed deposit, that is cash in bank, it actually gets transferred to cash in hand, but the overall M3 number will remain the same. So it leaves it unchanged. A simple straightforward question. So M3 formula is what you are expected to understand here. So if you just know the logic behind this entire question, you can solve any number of questions on the same topic. From economic survey, it is important to understand what is M0 and M3 trends, because in prelims examination we are seeing questions based on trends, steadily increasing and steadily decreasing. So we are looking at the patterns only here. Now let us zoom in into this particular table and take a look at it. Here there is an important point that you have to know. If you witness the growth rate, they actually came down, both broad money as well as M0. Does this mean that the cash in our economy has been reduced by RBI? Not really. Now we have seen that from the explanation of the multiplier effect, money multiplier effect, RBI will actually print money only when there are assets that are generated. You have to note that we are only talking about growth here. Let's say, for example, in a year, 100 is the base from which money is growing. In the next year, if the amount is 118, we can say that there is 18% growth. Now imagine if this is not 118 and this is just 112, we'll say there is 12% growth. Now if you are comparing both the scenarios, it does not mean that it reduced below 100%. So when we are seeing that M0 and M3 values are actually coming down, it only means that the lending activity in our economy is very low. And why is this lending activity low? Because banks are not giving loans in an uncertain situation like COVID lockdown due to the fear of NPAs increase, that is non-performing assets increase. It can be a possibility, right? If businesses fail during COVID times, that is one reason. It, however, still means that the growth is still there, but it is much slower than what was seen in the previous year. But if you take a look at this 2016-17, broad money is actually come down minus 12.9%. Why? Because of demonetization. Money was pulled out of an economy. Similarly, even the currency in circulation came down. Why? Again, because of demonetization. The same thing was explained in a very complex manner in the economic survey. Let us have a look. So, what does this particular paragraph say? Normally, in a lockdown time, loans were not given by banks. So, whatever growth that we have witnessed is because of banks giving loans to the government. So bank credit to the government was a major contributor to increase in broad money. What is broad money? M3. So this is what the paragraph says. The rest of the things are not really important from prelims and mains perspective. So that is all that you have to know regarding M0 and M3 and money aggregates topic from economic survey. The theory and basics are covered here. If you like the video, please like, share and subscribe. That's it for now. We'll meet again in the next chapter.